Hello everyone. Today we will talk about facility capacity planning and optimization. Alright, let's start with the basics of capacity planning. When we talk about facility capacity planning, what we are really doing is figuring out how much production capability a company needs to meet customer demands, both now and in the future. Think of it as balancing two sides of a scale. On one side, you have available resources like machines, people, and space. On the other side, you have got what customers are asking for. The goal is to keep that balance steady so production runs efficiently without overspending or falling short. So, when we say capacity planning ensures that your facility can meet current demand while staying flexible for future changes. We mean this, your setup should handle what's needed today, but still be adaptable if the market shifts. Maybe demand spikes because of a new product launch or drops during a slow season. Capacity planning prepares you for both. And while doing that, you are minimizing waste and using every bit of your resources effectively. Okay, now, let's move into the core objectives here. Effective capacity planning tries to make sure your production matches market demand as closely as possible. When that happens, you avoid machines sitting idle and you cut down on bottlenecks, those points in the process where work starts building up. It's also about smart investment decisions. Instead of buying more machines than you need, you plan ahead so your capital goes exactly where it adds value. In the end, you are reducing operating costs through smarter use of your resources and keeping enough flexibility to handle fluctuations in demand without chaos. And looking at the process flow here, capacity planning usually follows six main steps, and of course it can change. First, you measure your current capacity. Basically, you figure out how much your system can realistically produce right now. Then, you forecast demand, which means estimating how much you will need to produce in the near future. After that, you identify the gaps between what you can produce and what the market needs. Once those gaps are clear, you evaluate different options, maybe adding shifts, upgrading machines, or outsourcing part of the work. Then comes implementation, where you put the chosen solution in place, and finally you monitor and adjust over time, since capacity planning is never really done. It's an ongoing loop of continuous improvement. Okay, and when companies get this process right, they see measurable results, and these are just examples, of course. Costs can drop by about 15 to 13%. Throughput, the amount of work finished in a given time, can jump by 25 to 40%. Utilization rates can reach 85 to 95%, and lead times can shrink by half or more. So the gains are very real both in numbers and in day-to-day operations. Okay, this is done, and look at this. Moving on to the capacity analysis. Before you can plan improvements, you need to know your current situation, of course. That means measuring actual output, finding constraints, calculating utilization rates, and identifying how close you are to your theoretical maximum capacity. Basically, it's about knowing your limits clearly before trying to stretch them. Okay, if you look at the three bars here, the first one is design capacity is 100%. That's the theoretical maximum output if everything runs perfectly, no breakdowns, no delays, no maintenance stops. Then we have got effective capacity, which drops to about 85% because we factor in plant downtime like maintenance, cleaning, or breaks. And here the actually capacity often leads somewhere around 68% because it includes unplanned losses like defects, machine failures, or unexpected delays. Alright, now there are two key formulas you will want to keep in mind here. The first one is utilization, and here, what is that? Utilization equals actual output divided by design capacity multiplied by 100%. And this tells you how much of your total design potential you are actually using. Then we have efficiency, which is efficiency equals actual output divided by effective capacity multiplied by 100%. And this one shows how efficiently you are performing compared to what's realistically achievable after accounting for plant downtime. Okay, another important topic, bottlenecks. A bottleneck is any part of your process that slows everything else down. Its capacity is less than or equal to the demand placed on it, and because your system can only run as fast as its slowest step, think like chain. Finding and managing bottlenecks is essential. And looking at the process flow diagram, you can see several stages. What are they? Cutting, forming, welding, assembly, and packing. Each has a different capacity in units per hour. And here, the forming stage handles 80 units per hour, which is the slowest step. So it becomes the bottleneck. Okay, that means your entire system's capacity is also 80 units per hour, no matter how fast the other stage could go. The system simply can't move faster than its narrowest point. Now, the key principle here comes from the theory of constraints. Okay, it says an hour lost at the bottleneck is an hour lost for the entire system, but an hour saved at a non-bottleneck doesn't really help. So, any effort to improve throughput has to focus on that weakest link first. Okay, let's continue. Next, demand forecasting. Let's connect capacity planning with demand forecasting. These two have to work together. If your forecast says demand will rise, you should be preparing capacity in advance. If you expect a drop, you might reduce shifts or delay expansions. The point is to keep resources available when needed without creating unnecessary overcapacity. And that balance comes from analyzing historical data, spotting market trends, and understanding seasonality. So, looking at the demand versus capacity graph here, notice how demand fluctuates over months while capacity stays a bit higher. That gap between capacity and demand is called the capacity cushion, and it acts like a safety buffer, giving you room to handle expected spikes in orders or temporary disruptions. And capacity cushion strategy is here. Look at this. Let's unpack that concept a little more. The capacity cushion is basically the extra capacity you have beyond what you expect, no need. It's calculated with a simple formula. We can see what is that? Capacity cushion equals 100% minus the utilization rate. For instance, if your utilization rate is 90%, your capacity cushion is 10%. That means you have got a 10% buffer to handle sudden changes. Okay, and different businesses choose different cushion levels based on how stable their demand is. A tight capacity cushion works well when demand is steady and predictable. A moderate cushion fits cases with moderate variability, and when demand swings a lot or is growing quickly, companies often keep a large cushion to stay flexible even though it costs more. And when demand changes seasonally, companies can use different planning strategies. One option is a level capacity strategy where production stays constant all year and inventory builds up during slower periods to meet future peaks. Another approach is to chase demand strategy where production adjusts to match demand using overtime, temporary workers, or subcontractors during busy months. And which one works better depends on how much variability you can handle and what trade-offs you are willing to accept between costs, flexibility, and responsiveness. Okay, this page is done, and what is next? Alright, so now we are moving into capacity planning strategies, and think of this as the way an organization decides when and how much capacity to add based on demand growth. There is not one single perfect strategy that works for everyone. It really depends on your demand pattern, how much capital you can invest, and the level of risk you are comfortable taking. What we will do here is look at three main approaches: lead, lag, and match, and then see how most companies actually blend them in practice. Okay, lead strategy is here. What is that? The lead strategy is all about staying ahead of demand. You add capacity before demand increases. This means you are anticipating growth and making sure you are ready for it in advance. The benefit is that you rarely lose sales because you are already prepared for customer orders. You also protect your operations from being overloaded, but there's a catch. This strategy requires a larger upfront investment, and if your forecasts are off, you could end up with excess capacity that just sits there unused. So it's a high readiness, high cost approach. Lag strategy is here. The lag strategy takes opposite stance. Here, capacity is added only after the demand has clearly risen. You are basically waiting for proof that sales are growing before you invest in more capacity. This conservative method minimizes financial risks because you are expanding only when you are sure it's necessary. The downside, though, is that you might face a period where you can't meet demand fully. That can lead to customer dissatisfaction and sometimes even lost business. So, this approach prioritizes financial safety over responsiveness. And match strategy, as the name suggests, tries to stay closely aligned with demand patterns. Instead of big jumps like in lead or lag, you add capacity gradually and incrementally as demand increases. It's kind of a middle ground. Less financial risk than the lead strategy, but better customer service levels than the lag approach. The trade-off is that it requires continuous monitoring and frequent adjustments, which can mean more operational effort. Okay, and in real world, most organizations don't stick to just one of these. They usually use a hybrid approach. For instance, they might follow a lead strategy for a fast-growing product line, but apply um, lag approach for a major one with stable demand. So the actual mix depends on things like product type, market volatility, and competition. Okay, and let's look at tactical adjustments. These are short, medium, and long-term actions companies use to fine-tune their capacity. In the short term, the focus is on flexibility. That could mean adding overtime, hiring temporary workers, rearranging shifts, or even subcontracting part of the production. And these methods don't need big capital investments, but help handle sudden spikes in demand. For the medium term, companies might bring in new equipment, improve existing processes, or adjust inventory levels. These are more deliberate moves, slower to implement, but they provide a stronger and more stable capacity boost. And then we have long-term adjustments. These involve major decisions like expanding facilities, opening new locations, or investing in new technology. These take longer and require planning, but they are essential for sustainable growth. So short-term fixes keep things running, medium-term improvements stabilize performance, and long-term strategies shape the company's future capacity. Okay, now tools. Alright, let's talk about how to calculate capacity. And quantitative analysis is really important here. It's what tells you where you stand and how much more you might need. You can think of this as translating your operations into numbers so that decisions are based on data, not guesswork. And let's look at this interactive calculator example. Here you can see we have got a few parameters: available hours per shift, number of sheets per day, working days per week, and units produced per hour. And suppose we are running 8 hours per shift with 2 shifts per day and 5 working days per week. That gives us 8 times 2 times 5, which equals 80 hours per week. And if each hour produces 5 units, that means our design capacity is 80 hours times 50 units, which gives, what is that, 4,000 units per week. But remember, design capacity is a theoretical maximum. In real life, things like maintenance, downtime, or quality checks reduce that. So we apply something called overall equipment effectiveness, or OEE. And let's say OEE is here 75%, and that gives us an effective capacity of 4,000 times 0.75, which equals 3,000 units per week. So from that we can say weekly hours are 80, design capacity is 4,000 units per week, and effective capacity is 3,000 units per week. That difference shows how much of your potential is actually usable in practice. Look at this equipment, OEE, and units per hour. Look at this, working days here, everything is changing. For example, let's say 10. Okay, here everything is changed. Alright, let's move to the break-even analysis. This one helps you figure out how much you need to produce and sell to cover your costs. Basically, the point where you stop losing money and start making profit. The formula is written as like that. And what this does is compare your fixed investment with the contribution margin per unit. That's the money you make from each unit after subtracting variable costs. And the result tells you how many units you need to sell to justify the investment. It's especially useful when you are thinking about capacity expansion because it shows how much output is required to make that new equipment or facility financially worthwhile. Now, sometimes you will realize that your current capacity doesn't match the demand you expect over your planning period, and that's where gap analysis comes in. You compare the required capacity against what's currently available. If there is a shortfall, you need to decide whether to expand, improve efficiency, or manage demand differently. This kind of analysis is ongoing because both capacity and demand can change with time. Alright. Here we have roadmap. Alright, this is a structured process that links data analysis, stakeholder input, and ongoing monitoring. It's usually broken into 6 key phases. First, we start by establishing a baseline. That means measuring your current capacity, calculating utilization, and identifying bottlenecks in your process. You can't plan effectively unless you know where you are starting from. Then you develop demand forecasts. You use historical data, market research, and input from sales or marketing to estimate future needs. Next, you calculate capacity requirements, comparing your forecast demand with current capabilities and considering any desired caution or growth goals. Once that's clear, you move to evaluating alternatives. This could include adding equipment, expanding facilities, improving processes, outsourcing, or investing in new technology. After evaluating, you choose and implement the best solution based on cost-benefit analysis and feasibility within your available resources. And finally, you monitor and adjust. That means tracking performance indicators, reviewing capacity regularly, and making tactical changes when necessary. Alright, if you look at the timeline, you will see how these phases overlap a bit. The baseline measurement starts at month 0. Demand forecasting runs through the first couple of months. Gap analysis follows right after, and solution evaluation and implementation take up the middle phase. Monitoring and optimization continue beyond month 6 since capacity management never really stops, it continues. But now, for all of these to work well, a few success factors make a big difference. And first, there is cross-functional collaborations. I mean, operations, finance, sales, and engineering all need to work in sync. Then you need data-driven decision making. All capacity metrics have to be measured and analyzed accurately. Continuous monitoring is another key. Plans must be revisited and refined often. And finally, flexibility planning ensures the system can adapt to changes instead of breaking down when conditions shift. So, putting all of this together, I mean strategies, calculations, implementation, you can see how capacity planning is not just a one-time project. It's a continuous process that connects data, people, and strategy to keep operations efficient and ready for whatever comes next. Okay, last 2 pages and optimization here. So far we have talked about basic capacity planning, how to balance resources with demand, but in many real operations that's not enough. When systems get complex with multiple constraints and interdependent processes, you need more advanced tools to get the most out of your resources. And these techniques are designed to improve overall throughput and utilization, not just at one step but across the entire system. Okay, here. Now, one of the most widely used methods here is the theory of constraints, or TOC for short. The main idea behind theory of constraints is simple. Every system has at least one weak link, a constraint, that limits its overall performance. So instead of trying to optimize everything at once, TOC focuses on identifying that single constraint and managing it systematically. By doing that, you create a continuous improvement cycle that keeps your process efficient over time. And if you look at the 5-step cycle in the diagram, the process starts with identifying constraint. That means finding the part of the system that limits throughput. Usually it's the workstation or process with the longest queue or the highest utilization. Once you find that, the next step is to exploit it, meaning you make sure it runs as efficiently as possible. Eliminate unnecessary downtime, avoid quality rework, and make sure that the bottleneck never sits idle. Then comes the Third step, subordinate all other processes to support the constraint. In other words, align everything else around that weak link. Non-bottleneck resources should work in a way that gives the constraint path without overproducing. For example, if the constraint can't handle, let's say, 100 units per hour, there is no point in upstream processes producing 120. It will just cause pileups. Once the bottleneck is running at full efficiency, you elevate it. This means increasing its capacity by adding investment resources or improving processes. Maybe that means adding another machine, automating a repetitive step, or cross-training staff. And finally, fifth step is repeat. Because once you fix one constraint, another one eventually appears somewhere else. That's just the nature of system. So you go back to step and one start again. This is what makes it a continuous improvement cycle. Each round brings your system closer to optimal performance. Okay, and let's talk about linear programming. This is a mathematical optimization method used to decide how to allocate limited resources across different products or processes. The goal is to find the best possible mix that maximizes profit or throughput while staying within capacity limits. So, in simple terms, linear programming asks, given our available capacity, labor hours, and material supply, how should we distribute production among our products to get the best financial or operational result? For example, if you produce two products, say A and B, and each one requires different amounts of machine, time, and labor, linear programming helps you calculate how many units of each product to make to maximize your total profit without exceeding the limits of your production resources. And it is a way of turning operational trade-offs into precise data-backed decisions. Next, simulation modeling. This one is particularly useful before making big decisions or changes to your capacity plan. A simulation model is basically a virtual copy of your production system built inside a computer. You can run different what-if scenarios on it without disrupting the real operation. For example, you can test what happens if demand spikes, if a machine goes down, or if you add another production line. And this helps you see how your system behaves under changing conditions. And simulation is also great for capturing randomness, things like breakdowns, variability in processing time, or supply delays that are hard to predict mathematically. So, while linear programming gives you the best plan under fixed assumptions, simulation shows you how the plan holds up under uncertainty. Together, they form a strong foundation for advanced capacity optimization. Alright. And performance monitoring, our final page. Even the best capacity plan won't stay perfect forever. Market conditions change, demand fluctuates, and machines wear out. You know that. That's why you need an ongoing monitoring process to make sure your capacity plans are still effective. And the idea is to track performance indicators, things like utilization, throughput, and schedule adherence, and adjust before problems grow. Okay, looking at the dashboard here, you can see four main metrics being tracked. The first is overall utilization, which means in this example is 82%. That's within the healthy target range of 75 to 85%. It's calculated as actual output divided by design capacity, and it basically shows how much of your total potential is being used. Then we have got bottleneck utilization, which is 94% here. This one focuses on your constrained resource and measures how much of its available time is actually used. Ideally, you want this between 90 and 95% high enough to stay efficient, but not so high that there is no room for downtime or reliability. Next up is throughput rate, shown here as 4.2 thousand units per week. Okay, this measures the rate at which finished products leave the system, and the target here is around 4.0 thousand per week. So we are slightly above target, which is good. And finally, schedule attainment. Here 96%. That means 96% of orders were completed on time. The target range for this usually 95 to 98%, so this operation is performing well. Now, below the dashboard, we can see how each metric is calculated and when to take action. Okay, for example, overall utilization should be reviewed if it drops below 70% or rises above 90%. Bottleneck utilization should be elevated if it consistently stays above 95%, since that signals your constraint is overworked. Throughput rate should be checked if it falls by more than 5% from its normal level. Schedule attainment needs review if it's below 90%, and for capacity caution, remember that's unused capacity divided by total capacity. It should generally stay between 15 and 25%. If it falls outside the range, you adjust your planning strategy. Okay, and final part. To keep everything on track, capacity planning should have a regular review cycle time, usually once a month. During these reviews, you compare actual results with your planned capacity, identify any new constraints or inefficiencies, and check whether recent adjustments are paying off. You also look at updated demand forecasts and plan for upcoming capacity changes or investments. And here, the example shows that reviews happen every month, and on average, there are 3 continuous improvement projects per quarter. That's a good routine, frequent enough to stay proactive without overwhelming the team. And just to wrap this part up, capacity planning is not something you do once and forget about. It's a continuous process. Equipment performance changes, demand fluctuates, and organization itself evolves. So ongoing monitoring, feedback, and adjustment are what keep the whole system performing smoothly over time. And thank you for listening.